It's not often you find an investment that can do well in normal times, but do even better when the stock market is selling off. But I think I found one that can. And when I used this strategy in 2019, I doubled my money in about a year, right as the market was crashing in 2020. In this video, I'll show you what it is, how it generally works, and why I think it'll work again. If you're new here, I'm Ethan. I'm a CFA Charterholder and investment professional, and this is not advice, but my partner Kyle and I started this channel to help people change their lives by becoming better investors. And whether you decide this strategy is right for you or not, I think watching this video will help you do that. For what it's worth, I also just had my mom put 10% of her portfolio in this as a hedge, since she owned mostly US stocks. The main concept you need to understand in this video that drives the whole investment idea is that investing is very emotional, and at the extremes, it's often driven by either fear or greed. In our Psychology of Money series, we help you overcome that, but in this video, we're going to show you how to take advantage of it. People don't really understand the stock market, and their money is their livelihood. So when the market is going down and all the headlines turn apocalyptic, people want to sell. Selling makes the market go down even more, which makes even more people want to sell. It's a vicious cycle. The same thing happens on the upside. FOMO. When you see other people making a lot of money in something, you feel two things. One, that it seems safer because it's been going up. And two, is that you feel greedy or FOMO, that you don't want to miss out on all the gains. And your buying activity pushes up prices even further, which then causes more people to buy. Okay, that's concept number one. In this video, we'll be focused on the downside since we're talking about how to profit from the next stock market crash. So, when people are scared and they want to sell out of their stocks or risky investments, where do they go? Well, when you feel danger, you want to go somewhere that feels safe, right? And the number one safest investment, besides a bank account, is US Treasury bonds. When people rush to safety, that's usually how they do it. Now, here's the second concept to understand. We did 2 whole videos explaining this much more in depth if you're interested, but the very short version is that long-term bonds are more sensitive to interest rate changes than short-term bonds. Greater risk if interest rates go up, greater reward if they go down. To understand why, think about it this way. If you have a 2-year Treasury bond that pays you a 4% yield, and then interest rates on new 2-year Treasury bonds go down to only 3%, you can sell yours for a little bit more. Your bond will pay you 1 extra percent yield for 2 years. So if someone wanted to buy it from you, they'd have to pay you extra to get you to give up your higher yield. They're both Treasury bonds, right? They're both the same borrower either way. So nothing is different except for the yield. But it's only for 2 years. So it's only going to justify a slightly higher price. Maybe roughly 2% higher, right? 1% higher yield for 2 years. But what if it were a 30-year bond and you had the higher interest rates locked in for 30 years? Then someone would really have to pay up to get you to sell it to them. That's why long-term bonds are much more sensitive to changes in interest rates than short-term bonds. So those are the 2 basic concepts behind this investment strategy. People rush to safety in US Treasuries in almost every stock market downturn, and the longest term Treasury bonds have the most upside when yields go down. Of course, all that buying activity as people rush to safety is what pushes the yields down and the bond prices up. To see this in action, let's take a look at how interest rates have moved in every market correction since 2000, which is defined as a 10% or more drop in the stock market. The red line is where interest rates were at the beginning, and the blue line is where they were at the end. Focusing on the 20 and 30-year bonds on the right side of the chart, if the blue line is below the red line, it means that the interest rates went down, and this strategy would have made you money during the market decline. Okay, here we go. March 2000, peak of the tech bubble. The market fell 11%. 20 and 30-year interest rates both fell, which means their bond prices went up. So bond interest rates go down, prices go up. That's bonds 101, right? So the strategy worked. Next, we go to September 2001. Most people would call the first 3 market corrections that we're going to cover all part of one, but these dates and figures, at least the ones up through 2020, come from Invesco, so if you disagree with their methodology, you can take it up with them. It didn't work great in this one, but you did make money, and when you consider the fact that you were also collecting a 5+% yield, and the stock market was down over 26%, I'd say you actually did pretty well by comparison. In March 2002, you thought the tech bubble was over, but you were mistaken. There was another 31% drop over a 7-month period. This time, 20-year interest rates fell by over 1%, and you crushed it with this strategy. By the way, if you're wondering where the 30-year number is, the US government suspended issuance of 30-year bonds from 2002 to 2006, so they didn't exist at this time. Then we get to a little recovery for about 7 weeks, and no, just kidding, another 11% correction. Again, the strategy worked as 20-year rates fell about 0.5% in just that 7-week period. For reference, the duration or interest rate sensitivity on a 20 to 30-year bond is around 16 right now in January 2025. It can move around depending on where interest rates are, but that means that for a 1% fall in 20 to 30-year interest rates, those bonds would go up in price roughly by 16%. Less for 20-year bonds, more for 30-year bonds, on top of whatever they pay you in yield. Okay, so after a lot of false recoveries, we finally did actually get a sustained rally. No 10% corrections for almost 4 years. Statistically, they happen on average about once per year. So that's a very good stretch of time. But just as everyone started to feel safe, of course, here came 2008, the global financial crisis. The market sells off over 56%, while long-term treasury bonds rally hard. I think in 2008 there were like 8 stocks in the entire S&P 500 that went up. There was really no place to hide except for treasuries. So that is the ultimate environment for this strategy. Then comes 2010, the flash crash where algorithmic trading crashed the market. Long-term rates fell by almost 1% in just a couple months, and this strategy worked out great, all while the S&P 500 was down about 16%. 2011, European debt crisis, and the US debt gets downgraded and loses its AAA rating for the first time ever. Surely that will cause this strategy of buying treasury bonds because of their perceived safety to fail, right? Nope. Actually, this is one of the best times for this strategy, with long-term rates falling about 1.2%. So, meaning something like a 20% return in long-term bonds or much more in the strategy I'm going to show you in a couple of minutes, all while the stock market is down over 17%. Then we have another awesome period of over 4 years without a 10% correction, but that comes to an end in late 2015 when the market starts to worry that China's economy is going to have a hard landing, aka a rapid slowdown. Energy and mining stocks got crushed, the S&P 500 fell over 10%, but long-term treasuries, well, they went up. What a surprise. This may not seem to be as big of a move as the others, but keep in mind, this correction only lasted about 2 months and it barely even qualified as a correction. China ended up putting in a massive stimulus plan, and basically the party ended up keeping going for another few years. This takes us to 2018. People were worried about the trade war with China, and get this, they were worried that the Federal Reserve was raising interest rates too quickly. If you look over on the left, you can see that short-term interest rates were actually going up, but over on the right, long-term interest rates still went down. Why? Because people were scared and rushing to safety. It's psychological. Then we get to 2020. We all know what happened there, right? This was the first time that I used the strategy, and I made about 100% return in just over a year. I actually started in early 2019 in preparation, just like I'm doing now in 2025, but we'll get to that in a minute or two. Before we get there, we have to talk about 2022. This is a very important part of this video because this strategy would have done horribly in 2022. Long-term interest rates rose by 2%. That is a lot. That's because, one, their starting point was an all-time historical low of about 2%. So probably not a great time for you to bet on them to go down. And two, inflation rose dramatically to its highest level in 40 years. This is the only kind of environment where the strategy will not work out well. I mean, I guess if we're being technical, maybe if people lost faith in the US government or the dollar, this would probably also not work out well. But the dollar is the reserve currency, and the US government can print it to pay back its debts. So this is the only realistic scenario when this strategy would not work out well. If the market crash is being caused by inflation expectations rising a lot. Remember, when you buy a 30-year bond, you're locking in that interest rate for 30 years. But if inflation goes higher than the interest rate you're getting, your value will just be eaten away, right? So you always want your long-term interest rate to be higher than inflation. If people expect inflation to go higher than the interest rates on your long-term bonds, that's called negative real yields, which means adjusted for inflation, and it's very bad for long-term bonds. Like I said, where were long-term bond rates at the start of this period? 2.05%. And what's the Fed's inflation target? 2%, which means you'd really expect long-term bond rates to go back to at least like 3%. So this would have been a horrible time to implement the strategy betting on interest rates to go down. And in my opinion, that was pretty obvious at the time. And this isn't just hindsight being 2020, which, everybody loves to do. I did implement the strategy in 2019. I sold out completely in 2020, and I did not get back in until 2025. For the sake of completeness, here's one more 10% correction that happened in 2023, also caused by inflation fears, where the strategy would not have worked out. Now, in this case, there's proof that we were telling you not to buy long term bonds. This came from a video we released on February 24th, 2023, where my partner Kyle said, "But I believe the market is overestimating how fast the Fed will cut rates. In this scenario, medium and long-term interest rates could go higher." That was from this video. What is a yield curve and how to read it like a crystal ball? Of course, then long-term rates did go higher, and by the end of this chart in October, they were at about 5%, pretty much where they are today. Well, where they were on January 13th. They've come down slightly in the last couple days as I'm filming this. That brings us to my strategy, and there are two ways to implement it. TLT is a 20+% treasury bond ETF from iShares, and TMF is a 3 times leveraged 20+ year treasury bond ETF from Direction. I personally use TMF, which has a much higher risk reward profile, but that level of volatility isn't right for everybody, so I'm going to show you both. For illustration purposes, this is a chart of the same period, October 17th, 2023 to January 13th, 2025, where 20 and 30-year treasury bonds stayed almost the same. Of course, they didn't stay the same the whole time. They were super volatile, but they ended up at about the same place. So here's what happened. On November 13th, 2023, we came out with a video saying that inflation expectations had gotten way too high and were likely to come down. You can see that both TMF and TLT rose from there over the next couple months. TMF by about 50% and TLT by about 15%. To be fair, we also came out with this video about a week later saying that intermediate and long-term bonds were a lot more attractive than they had been in years, and it was okay to get back in. But since real rates were still negative and the yield curve was still inverted, meaning short-term bonds were still paying you more than long-term bonds, we said they were more attractive as a hedge to the stock market in case of a downturn, as opposed to something that I was just pounding the table everybody should buy right now. So I didn't end up getting back in yet, and I missed that short-term rally. But of course, TLT was basically flat and TMF was down by the end of the year, so my fears did end up coming to pass. Now, we also put out a more cautionary tale on this on December 31st in our 2024 bond market outlook, and another one at the beginning of March in this video. So why now? Well, not only have long-term interest rates come back up to around 5%, but finally, the yield curve is no longer inverted, meaning longer-term bonds are paying you more than shorter-term ones. That's normal, but it hasn't been that way for the last few years. And more importantly, we have positive real rates, meaning inflation is nowhere near 5% anymore, and I really don't expect it to be that high in the long run. That setup reminds me a lot of when I first started buying TMF in 2019, with a couple key differences. At the time, the market was expensive, we'd been on a long run, but I wasn't exactly predicting an imminent market crash. I just thought there's probably one coming at some point for some reason, and whenever that happens, investors are likely to rush to safety in long-term treasuries, which should be great for TMF. Right now, I see something similar. I also saw this. TMF, the blue line, had basically matched the S&P 500, the red line, over the prior 5 years, even in an equity bull market. Obviously, this is very time period specific, and if you'd started a little later or a little earlier, it could have done much better or worse. But I thought, okay, even if I'm early on this, I can actually do all right while I'm waiting. At 5% yields, I still feel that way now. And the big key in 2019 was, how can this go wrong? Well, pretty much only if inflation goes up a lot, right? Because that's what would push up long-term interest rates. Well, at the time, the Fed was trying to get inflation up to their 2% target, and they couldn't do it. So I figured rapidly rising inflation wasn't exactly a huge risk. Fast forward, and I bought more later in February 2019, more in May, June, July, and December of 2019. And then I got the stock market sell-off I had been waiting for in March 2020, and TMF took off like a rocket. I sold my shares between March and July of 2020 at an average gain of 89%, plus whatever I got in dividends over that time period. Do you think I was predicting a global pandemic? No, definitely not. And I have no idea when or why the market will sell off next time. I could give you a guess, but I really don't know. I just know it will eventually, and when that happens, for almost any reason, TMF and TLT are likely to rally. So that leaves us with one big question. What is the risk that inflation will spike and TMF will burn you like it did in 2022? In my opinion, this risk is low, but not as low as it was in 2019. Unlike the last time rates spiked, 20 to 30 year treasuries are paying you around 5% now, not 2%. That's much higher than long term inflation is expected to be. Actually, the 30-year treasury rates are the highest they've been since 2007, other than a brief period last year in 2023. And we saw what happened after that, right? TMF and TLT rallied over the next few months. So, could tax cuts and tariffs and a strong growth environment be inflationary like every investor and their mom expects already? Sure, they could. That's why long term interest rates have risen about 1% over the past few months. The market is already pricing that in. Could Trump also not get his tax cuts through, or could he use tariffs more as a negotiating tool and the ultra high levels that are feared right now never come to pass? Also, yes. And that would likely cause inflation expectations to come back down and thus rates to come back down. And more importantly, could there be a market crash at some point for some reason? Yes, I'm quite confident that there will be. And while it's possible inflation and long term rates could go higher from here, I doubt that they will be the cause of the next market crash. And if they're not, TMF and TLT could rally, just as most other investments are falling. That's why I started a position. That's why I just had my mom start a position. And just like in 2019, I'll plan to keep adding it more and more as the stock market keeps rising because usually the higher valuations get, the closer we are to a correction. We didn't have any in 2024. Remember, they happen about once a year. And the stock market valuations are now almost back to their highs from the tech bubble. So, a little insurance, so to speak, doesn't sound like such a bad idea to me. If you've enjoyed this video, please hit that like button, leave a comment with what you'd like us to cover next, and subscribe so you won't miss it. And if you'd like to connect with my partner Kyle and I directly, you can do so by joining our Discord through the link in the description below.